traders. It is I, Abdul Shabazz, and this is some real change stock options trading journey. And today, Thursday the 13th, we want to thank you all for joining us today. As we do appreciate you for joining us and for tuning in. Big shout out to the Kick family, those of you who are tuning in on Kick. Shout out to you as well. Do appreciate you. And we will be getting this morning started here shortly by giving the market some time to get itself acclimated before we decide to go ahead and start picking it off. I'm going to show you my plans here very shortly, as I always do. I am looking for a call, okay, above the 775 area, break and retest. Believe we could take that to the 777 area. And if the market does come down, I'm not interested in a put unless or if we get down to the 772. If we get down to the 772, then I will take a put. If we get a break and retest of the 775, then I will take a call. It's all about ifs and then. If the market does this, then I'll do that. And if the market does that, then I'll do this. Trading is not about winning or losing. Trading is about performing. Your job is to perform by executing your plan every single time, regardless how you feel inside. Allow it to become boring. Boring is where the money is being made. Salivating at the opportunities before us. What a beautiful morning. Jesse Swanson is in the building. Shout out to you, Jesse. Bismillah, here we go. Big drop. I like that drop too. I do. First 5 minutes, very volatile. First 15 minutes can trick you. If you're thinking the market is going one way and then completely going a different direction, give the market some time to reveal what it wants to do. We'll get her. If anybody else has any plans they would like to share, just let me know what you're thinking. If you're going to give the market a little bit more time, either way is fine. Just want to know what you was thinking, teammate. Anybody else want to share what they're thinking? That would be great as well. But you know me, first 5 minutes very volatile. First 15 minutes can trick you. I'm going to give this market just a little bit of time to settle down. Okay. Sir Night is in the building. Shout out to you. Long to the broskies. Aaron Smalls is in the building. Long time. Aaron Smalls in the building. Yes, sir. We are back in full effect. I am done with my water travels. Okay. Done with my water travels. So we are back in effect. Looking for a break and retest in this area. Beautiful washout, long potentially. And I went on ahead and bought in right there where I told you guys I would at that 775. Let me go ahead and put an arrow on the screen so you can see that I bought in there. I'm gonna put a green arrow. Call this out early. As I stated that I was interested in taking a 775 call with a break and retest with that 775. If we get a retest, I'll add to it. But we might not get a retest. I believe we can take this all the way to the 777. We will see. However, I'm grateful that I'm already in the trade. And up quite a bit. Okay. And I went on ahead and got out of that real quick for some nice profits this morning. If we do get the retesting, I will get back in. But I see a little hesitation right now. So I wanted to maximize my option price. And get out with those beautiful profits. So shout out to me. Good job. Okay. Still believe it's going to go all the way to 777. But I wanted to take some of those profits right there while the market presented them to me. Looking to see if the market gives me a second opportunity. Something I need here. Jesse said calls off the daily. Not sure on the entry. Heavy workload today. May not get to watch. Big Ben is in the building. Good morning, Dr. J, Abdul, Jesse, and Sir Night Night. Yes, sir. I got out of that just a little too early. Called out the 777 profit target. Called out the 777 profit target. Got of it a little bit too early. Let me go ahead and pop myself, but I'm still grateful with those profits, no doubt. I typically don't like trading early, but I had to take the trade as I called it out. I have no control over when the trade takes place, but I saw the call at the 777, adding at the 775.3, taking profit at the 777. Instead, I took profit at almost at the 776. So, still, I can't complain. To be 10 minutes into the day and already with some very nice lunch money. Yes. I mean, I can even get cheese on that burger and leave a good tip. On to the next trade. Overall market is looking very strong this morning. The overall market is looking very strong this morning. Recuperating from yesterday's low of 772, market hopped up almost $3.60 right now to 776.1 is where we're trading at right now. Well, I'm back to being patient, back to allowing the market some time to set up. We'll be here. We are back on team. We're back like Voltron. Back to sharing my ideas, sharing my trading ideas in the morning. And this morning I shared two ideas for a trade, and one was a call at the 777 and one is a put at the 772. The call has been activated and right now is still valid. However, I didn't hold it all the way to profit target. As you guys know, I am a premature exiter. And I'm still working on that problem. Alhamdulillah. Market coming right back down to where I originally got out of. All within that first 15-minute candle. It was a scalp trade, and that's why I treated it as a scalp, because I really wanted to see the break and the retest. My plan was to buy in on that break of the 777. The only reason I did that is because we had a washout long on that initial 5-minute candle. Let's blow that up so you can see exactly what took place. The same thing happened on all candles, the 15 and the 30 minute, because it happened within the first 5 minutes. We started off red. It was a nice sized red body candle, and then it got flipped from red to green. So all those early bears were in trouble, and you know that's how we trade. Who's in trouble? Once those bears had to cover, that gave me the opportunity to get out in their covering as those early bears got flipped as the candle went from red to green and gave us a nice push up to that 776.4 area right now, which is temporarily the high of today. Big Ben said it best. Bottom line, you got to stay alert. You don't know when the opportunity is going to present itself, but you definitely have to be ready for it when it does. More trading opportunities on the way for today. The writing is definitely on the wall. Let me go ahead and clear up. Nice pullback. Very nice pullback. Let's see if it holds and gives us a new high. Market is looking very strong right now. Yes, it did. Aaron said, I got in early, got out at the peak, back in again. Yes, sir. Aaron shooting for that 77.7 price target. Coming right at you. Potentially putting pressure on those previous candle bears. Put them in a position where they might have to cover. It's looking good. Yes, sir, Aaron. Good move, buddy. Right to that clear area of resistance at the 7767 is where we are now, where I have a line at. Yes, sir. Beautiful trading, teammate. Beautiful trading. Definitely going to be interested in that 10 o'clock candle. Right to that next clear resistance area there. Close enough, 77696. Beautiful, beautiful, beautiful. Little pullback here is to be expected. This is an area of resistance, as you can clearly see with the line that I have here. Every line on the chart absolutely being something. The market is still looking strong. The market is still looking strong. Yeah, Ben, Jesse, and Aaron, I should have stayed in it a little longer, but again, it was a scalp. So I just, I can't complain about the profits. But the aftermath, we always want to trade it as best as possible. So that's what, we come to the trades. We come to the market with the mind frame that our preparation gives us an edge, and we like to trade with edge. So we expect to win. We're not excited about wins, and we don't get depressed about losses, because we understand that losses are part of winning as well. But we do expect to trade to our very best. So no matter when we win, we still analyze the trade and see how we can trade better. And if we take a loss, we analyze the trade and see how we can trade better, as we have reached that 777. Profit target that I called out earlier that I should have held on to. That's all right. I'm gonna kick the dust off. And I'm gonna get better and hold it on for the much larger profit, guys. Can't thank you guys enough as I sit back, wait for this 10 o'clock candle to come, and continue to root and cheer on my teammate who is still getting to the money. It's not about me, it's about we. We all share the information, knowledge that we have, so collectively we can sit up here and do our best to provide for our family and those things that we care most near and dear about. No matter what, all of us together cannot put a dent in this market. So there's no reason that we should not join up like Voltron. So I thank every teammate that is on here. Shout out to you. I'll be right back at 10 o'clock. Go ahead and turn it over to people from CNBC, see what they're talking about this morning. Let's freaking go, Jesse. Let's freaking go. Let's freaking go, Aaron. Let's freaking go.
Freaking go!
Yes, sir. Pay attention to the clock. 1 minute left. Definitely at the 59. I don't know how large of a position that you have, but you want to take some profits at this 30 minutes. Don't let that 10 o'clock candle kick in and pull back a little bit and take back some of where we are on that option chart right now. So pay attention to that. Oh yeah, I know you're still in it. You're supposed to be. Absolutely. I'm just reminding you that at 10 o'clock, there could be a slight dip. So there might want to be a good area that you might want to put just a little bit in your pocket. Closed out, some runners now left. Exactly. That's exactly the way you do it. You get closed out right before 10 o'clock, and then you let the runners do their job. Picture perfect trade teammate. Very good job, sir. Thank you for showing me the way I should have done it. And you can see exactly what I was talking about right here, however slight. But at 10 o'clock, you have just a little bit of hesitation. Okay? And that little bit of hesitation, that little bit of pullback will stop that option chart from bouncing up like it normally does. So you definitely want to take some profit there. And like our teammate says, you hold on to that runner and let it run on. You now have the trend. You now have the momentum. It's green for the month, green for the week, green for the day. The 30 minute is green. Let that runner do his thing. Shout out to your teammates and everybody who got paid today. Excellent trading. One and done. Maybe some frosting a little later. Hey man, that's how we do it. Shout out to the team, man. Everybody took a trip to the bank today. Yes, yes, yes. Plenty of room in the car going to the bank. Jesse's a winner. Aaron's a winner. I'm a winner. Ben, I know you're a winner as well. Come on, man. Let it die on the chart or go diabolical. Exactly. Move that up. Move your stop up to where your profit target was. So that way you locked in at the 777. Goes, matter of fact, move that up to the 777.5. Okay? You do a trailing stop with that. You do a trailing stop with that last contract. Don't let it turn around on you. You give it a little room, but you do a 50-cent trailing stop on it. Just simply beautiful and marvelous, man. So happy for the team. So excited, man. So excited. And we are back. Give me a second, guys. The cat's going crazy.
It would be that group, and that's continued to grow. Both new retailers are new entrants in that space, but obviously the legacy retailers as well. Airbnb, again, they say that they're putting off travel, but guess what? Growth among our first-time bookers was 11%, the highest growth we've seen in 4 years among the first-time bookers. The Gen Z cohort is growing the fastest. Tapestry, we'll talk to the CEO. Growth was led by Gen Z. Starbucks. S'mores beverages are resonating particularly well with Gen Z customers. Our strongest summer coffee launch in the past several years. American Express. I mean, so it is really across the board here. Millennial and Gen Z, which make up the largest share of U.S. customer spending, remained our fastest growing cohorts this summer. Just thought it was an interesting juxtaposition, given that they are such an important now voting class. I think 50 million Americans of this, younger Americans will be voting in the midterm elections, and it's a big increase from last time. They've 28% turnout in the
They can vote. They're not voting. They're eligible to vote. There's no way 50 million of them are voting.
No, that would be huge.
Yeah.
I think
they don't show up typically, so.
28% though voter turnout for young people, according to Tufts, in the 2025 mayoral election, and that was the biggest ever that we've seen. So,
you mean here in New York?
Here in New York.
Yeah.
Yeah.
So, are you questioning the actual survey itself?
No.
Sarah? You seem to be.
No, I'm not questioning the survey. I'm
Really?
questioning the Gen Z hypocrisy. No, I'm questioning.
And we're saying that people don't answer honestly.
I'm saying that surveys in general reflect sometimes political considerations. They reflect how people are feeling, how they're sensing the environment, but they don't necessarily reflect what they're doing, which is they are clearly spending. And I think that gap, it's something we've seen, throughout surveys.
Yes.
Well, it all makes sense if you look at how they've been locked out of the housing market. They're certainly not saving for a down payment as the age of the first-time buyers has been skyrocketing. They're starting families later in life. They're getting married later in life. They're beginning to draw down on their savings with a saving rate barely 2.5%.
And unemployment rate is higher than the national average. I mean, we do have that out there too, which is the college grad unemployment rate, which has been a big story. It's not a problem like in China or Europe, but it is higher than the national average, which is, definitely part of the story here. And I think also reflects some of the anxieties around AI that they have.
Health insurance.
Also problematic when it comes to surveys. But I think it's interesting that a number of consumer companies have been calling out this age group as some of the best spenders as well.
Again, if you're not saving for something big, you might have more money to buy a concert ticket in the
Or
near
maybe
term.
you're not as miserable as you think. For more on today's market action, let's bring in Rebecca Patterson. Rebecca is a former chief investment strategist at Bridgewater and separately a senior fellow at the Council on Foreign Relations. Welcome. It's great to have you.
Hello.
I mean, it is sort of interesting overall to watch how consumers continue to spend in this economy, even if they feel lousy. I mean, would you say that that's a theme?
Yeah, I think what they're spending on is changing, and it depends on the cohort we're talking about, whether we're talking about upper income consumers who are benefiting from homes they own and the equities at all-time highs. I think about my children, who right now might be some of these hypocrites, according to you, Sarah. But they are spending, but what they're spending on is interesting, right? Like everyone is buying secondhand goods. That's become a huge thing. If you don't wear something anymore, you sell it online and use the money you make for that to buy something else. So there's twists and turns to it, but overall I agree. The consumer is holding up okay. I think if there was a negative dot on that, it would be yesterday. The real earnings continuing to go down for the last 4 months. That's something we have to keep an eye on, right?
Yeah, I mean, I guess the other thing that we learned is that inflation, consumer inflation, is it headed lower? Are you less worried about it?
You know what? No, I'm still worried about it because a lot of what's driving the inflation is supply side, right? We don't have enough workers. We saw that in the last payroll report, that the supply, the labor participation is going down. People are retiring. We have fewer immigrants. It's supply of energy. It's supply of homes, as 80% of mortgages are under 4%. So right now, it doesn't make sense for them to list their home and move. So inflation, there's demand-driven inflation that the Fed can address easily. And then there's supply-driven inflation that's frankly better addressed by the government, but our government doesn't seem, and I'm not making a political comment, I think both sides of the aisle, they don't seem terribly inclined to do much that's going to address any of the supply-driven inflation quickly. So I'm not confident we're going where we need to go.
Yeah, this is a topic of discussion today, given that the jobs number was weak, CPI was tame, PPI is tame, 10-year doesn't respond like you might think.
Right.
Is it reflecting more about structural debt and deficit concerns that the Fed really has no control over?
Well, this is the challenge for the Fed, and I think a number of Fed officials are now talking more about this. If the Fed holds steady in September, and maybe CPI and PPI this week help them do that, we have more numbers to come. If they hold steady, there's a question around their credibility, and that can push up interest rates on the long end, and that hurts the housing market. It hurts overall borrowing costs. If they do raise rates in September, then you've got, what is it flowing through to? It's not going to affect housing much at this point. it is going to affect perhaps AI, which is one of the biggest drivers of the economy, right? Because now more of those companies are tapping the debt markets, and higher debt costs are going to make that math harder for them.
I'm sorry, I'm dying to ask you about the Japanese yen because I know you're all over that.
Let's go there.
Right?
Let's go there. Well, it all ties together because at the end of the day, that intervention is about the Treasury market too. But
no. So I think it's really important. Does that signify that U.S. Treasury would do it again? Because it's starting to go the other way. I mean, it's lost half of the gains.
Dollar yen is around 159, just under 160 again this morning. I mean, you are seeing, I think, pressure on the Bank of Japan to raise rates as early as this September, maybe October, and that's probably coming a little bit in part from the United States. The challenge, though, again, there's no easy path. If the Bank of Japan raises rates to try to strengthen its currency, it pushes up its yields. So Japanese yields are more attractive, which makes it more likely Japanese people bring money home because the yield is now more attractive. What do they sell when they bring money home? Bingo, treasuries. And that pushes up our yield. So this is a really hard dance. I don't think it's easy for Bessent to get his 10% treasury yield at 3%, which was the goal originally, anytime soon.
You don't think it's happening?
No, of course not. I mean, we're in a different world order structurally, right? Fragmentation, geopolitical risk, self-reliance, bringing supply chains back on shore. All of these things are structural inflationary pressures that push the yield higher. It doesn't mean it's going to be at 4 or 5% forever. It's going to go up and down with the cycle, but it means we're settling at a higher level than what we've had the last 20 years.
Well,
the world's changed.
We have a 30-year auction coming up. Jim Cramer this morning at the top of our show saying he's a buyer. I'm curious what your thoughts are.
I think there's a lot of fixed income shops right now saying this yield, just looking at the level, is very attractive, and I want to take some of that. I think a lot of retail investors out there are saying, you know what, my money market or my high yield cash looks pretty darn good, and I don't have to take that duration risk. So have fun, Jim. Have fun, institutional investors, I'm good. And that's a challenge too, right? If wealth managers can't get that huge retail universe out of cash and into products that pay more fees, that's a challenge for them. I would not be a buyer of the 30-year today,
oh, really?
Personally.
Why?
Why not?
No.
I mean, neither would Jamie Dimon for that matter.
Because you're high yield. You think yields are up, right?
I think yields are going to be higher for longer. I don't know how much the Fed raises rates or will need to raise rates, but I don't think they're coming down anytime soon.
You think they're going to raise rates this year?
I think there's a decent chance of it. Again, even if you say, like, for example, energy, right? Energy was the big gap between CPI headline and core yesterday. Even if energy comes down, we have a resolution to the war soon. What about the CapEx demand? What about the inflation coming through from your Gen Z spenders? You're angry but spending Gen Zers, right?
The depressed spenders.
The hypocrites.
If the hypocrites are spending, that is something that's going to keep wages supported, goods supported, services supported.
But wages are not really moving up.
Wages haven't moved that much, no, which is interesting because the labor market's tightened with the lack of supply, but you don't have that much demand either. For
Although
labor.
some argue that wages are not a pure tell because of the other costs of employing somebody,
Fair.
Health insurance.
Oh my gosh.
It's not a clear signal.
I think the rise in the cost of benefits for workers has been one of the biggest challenges for corporate America, probably frankly around the world in the last few years. And as we see more companies now saying, we're not going to give you insurance, we're going to give you some money and you go get it yourself. I mean, to me, that was a really big data point. I think it was just in the press this morning.
Bloomberg.
And I was reading that.
Yeah.
Sorry,
Yeah,
I wasn't going to say
No.
the
I mean,
word.
that was a practice. They were one of the last
Yeah.
to offer that to their employees.
They had great health insurance,
Yeah.
But
Oh,
if we could bend the cost curve on
Many years
healthcare, a la all of the promises that AI holds, for example,
Right.
that would be
Right.
significant across such an important part of our economy
100%.
overall, including our structural deficits.
But that isn't coming this year or next year. The promise of AI, that we get this productivity lift that's disinflationary, maybe through things like healthcare, I think it is very possible. But what is the probability I put on that? What's the time frame I put on that? No one knows. Zero. Nobody. Nobody knows.
No, they don't. They don't. You're right.
Well, this was fun, Rebecca. Always love having you.
I enjoy
Thank you.
coming.
Thanks for everything.
Thanks for everything. Rebecca Patterson.
Got a news alert on Databricks this morning, that mega-sized private software company laying out some new financial information, saying it crossed a $7 billion revenue run rate. That's up more than 80% year on year. Says it closed a new $5 billion strategic funding round at a $190 billion valuation. Company says it will use that money to fuel its AI strategy. Coming up later, we'll be joined exclusively by the co-founder and CEO, Ali Ghodsi.
One of the biggest private companies out there right now. I think that's a question, too. All right, here's our roadmap for the rest of the hour. When we come back, is Bitcoin due for a bounce back? We'll talk to the CEO of crypto exchange Bullish, just out with results, his view on the beaten down crypto space.
Plus, the CEO of AI Play Cerebras is with us, as that stock also down sharply this morning, despite what was a beat and raise quarter from the company.
And we'll talk to Tapestry's chief about earnings and her read on the consumer as that name gets hit hard on results as Squawk on the Street continues.
Beautiful trading team. Shout out to the team. Ben, how you doing so far in this trade? You doing great? I know you are. Shout out to you as well. Aaron is going diabolical, buddy. It is going diabolical. And we're going to continue to allow the charts to do what it does. Take advantage of these opportunities as they present themselves. See, we got a controlled buying algo right now identified on the screen and seeing how the stock is acting in between those algos right now. Thank you guys so much for tuning in, for hitting the like button and subscribing. Look forward to bringing this to you. I know, still on, still in, Aaron said. Yes, sir. That's what I'm talking about, Aaron. Still in. Let it go diabolical, buddy. Let it go diabolical. Look to the larger time frame now, the larger charts, 15-minute and 30-minute. If you don't see anything on that for you to turn around and get out, don't do it. Got the algo up for you so you can use that as a guide as well. Great Thursday. Every day is not going to be a trading day, but the days that we do trade will be worth it. Alrighty, guys, I'm here. I'm just in the background.
Welcome back. Shares of Bullish jumping this morning after the digital asset platform posted a beat on revenue and EPS miss while raising guidance for the rest of 26. Stock is still down for the year, though, tracking that move in Bitcoin. And joining us here at Post 9 in a First on CNBC interview is Bullish CEO Tom Farley, of course, famous as president of the NYSE from 2014 to 18. Today also marks exactly 1 year since Bullish went public. Happy birthday to the company.
Thank you. Yeah, it was a great year. What a different time it is for markets generally, but also for crypto. But I came on set with you guys a year ago, and I went back and watched that in preparation for today.
Oh, really?
Yeah, and I didn't talk about this trend of tokenization, which is really where we've positioned our company for the future, and it just kind of was one of the ways that I think illustrates how much has changed in just a year.
Yes. What was constant from that interview a year ago?
Very little, other than, hey, let's continue to build a good business that focuses on public blockchains and be adult and compliant and institutional, which is our focus. But look, Bitcoin was 120,000 on the day of that IPO and the interview. It's now around about 60,000, so it's in half. The market cap of crypto was $4 trillion. It's now $2 trillion. Yeah. The Clarity Act was hoped for. It did not pass this session. So we're in a tough spot for kind of historical crypto, pure crypto. What has changed for the positive is the question back then was, will this tokenization thing happen? By tokenization, I mean the giant global securities market, 300 trillion, moving to run on public blockchain rails. And now we just had our earnings call. The questions are no longer, will it happen? It's, hey, Tom, how quick will it happen? How much of a winner will you be? And so that part is really exciting. The pure crypto part is less exciting. It may turn out that it wasn't frog coins and digital cartoon drawings of animals that were the future of crypto, but it was actually this massive thing called global finance and the global financial markets, which may ultimately be much, much better, but we're having to go through this pretty tough dip.
It's a transition. You did come on a few weeks ago, I guess, where you talked about Clarity and could it be squeezed in before the recess. Where do you think it stands when they return?
I mean, it's not good. It's not good. Look. Let me start with this. I very much would love the Clarity Act, and I've said that from the beginning. And I encourage our colleagues in the industry to stop complaining and stop your kvetching and just get behind the bill, because with Clarity Act, I was convinced we would get another institutional wave. Like, there's some really big, well-known banks here in New York City that still don't hold Bitcoin on behalf of their private wealth clients, and I think the Clarity Act would be helpful in that regard, just providing more certainty. Okay. With that, I will say it doesn't really impact our business model, because where we're headed with our business is about securities, and there's 100 years of laws and rules that underpin how securities should work, and it's pretty clear. But to answer your question directly, Carl, there's a lot going on with this bill. I mean, there's some Republicans that kind of peeled off around this stablecoin issue, which I think is absurd. It's perfectly fine for stablecoins to pay some sort of yield.
Right.
But there's some issues around DeFi and the protections of DeFi, and there's some real issues with so-called ethics, which involves the Trump family. And the closer we get to an election, the harder it'll be to compromise. So where we're sitting right now, it doesn't look good, and we need some leaders down there, some profiles and courage to say this
good
is
luck
good.
with that.
Yeah,
Tom.
yeah.
Good luck with that. You talk about securities. I mean, when are we going to get to the tokenized stock trading? I guess immediate settlement, sort of that world that you've been talking about for a while. But how far are we from that?
So thank you for that question. In part because I can tell you, for the very first time yesterday, we traded tokenized stock. It's small. This is just a start. What we did is we took our bullish stock, which we tokenized on the day of our IPO, or pardon me, on the day of our announcement of the Equiniti acquisition, and we traded it on our own regulated venue yesterday among several counterparties. Okay, so that's the first step. We had to get the regulatory approval. We had to make sure the pipes and plumbing were there, but it's only one provider. It's going to take time. There will be more in the third quarter, more in the fourth quarter. It feels more like 2027 is when we'll see it ramp up in earnest. Why? Two reasons. One, the liquidity doesn't really exist in a meaningful way. A number of well-known, we're sitting here, the cradle of capitalism, they've announced they will trade tokenized securities. They're not live yet. That's one example.
Isn't Robinhood doing this?
Robinhood, well, many others are trading synthetic tokens, so IOUs or derivatives or so-called wrappers. Very few are trading the issuer-sponsored token, where, Sarah, the distinction is, you'll understand this, the importance of this. The distinction is, with an issuer-sponsored token, the token is the actual share. It's not a derivative.
Right.
If you own the token, you get the dividend, you vote, all of those sorts of things. So number one problem, the liquidity isn't there, but it's being built by us, by others, our host here. And number two, the issuers want to understand this thing before they go ahead and dive in head first, which makes perfect sense. And so we're working with the issuers. We will have 3,000 issuer clients with the closing of our Equiniti transaction. We're talking to them every day. The pipeline is building, but they don't want to just jump into it. They want to make sure it works for them, and ultimately it will.
Your stock is up today after the results, but obviously is down big over the last year. I mean, can your business work if crypto remains depressed?
Yeah, thankfully, yes. On May 7th, we repositioned the business towards this global securities opportunity. Equiniti is a global leader as a transfer agent. They have hundreds and hundreds of $1 million of cash flow, 3,000 issuer clients, 15,000 clients overall, and they are, I would argue, the best positioned entity to be a leader in working with issuers in terms of this tokenization trend. We will close that transaction likely in the first week or two of 2027. And irrespective of the growth of the Bitcoin, let alone frog coins, that wave is coming.
Okay. Well, what is wrong with Bitcoin? Do you think it's AI that's just capturing the
Maybe it's
imagination.
encryption risks. No, some of that.
I think there's one other. I think there's one other thing, which is AI has brought a lot of attention and a lot of dollars. I think a lot of eyeballs have moved off Bitcoin. But look, we own 24,000 and change Bitcoin. Don't hold me to the exact number. We're not selling. In general, we think Bitcoin's up and to the right. We think Bitcoin's great. We think Bitcoin and these layer one blockchains are the core of the digital assets space, and we always have. That's why we service institutions. That's why we only issue dozens of coins, not thousands. Ultimately, we're believers in Bitcoin price action, but I have no idea where it's going tomorrow.
Do you think the stronger bull case on it is payment mechanism, inflation hedge, something else?
Store of value, and it's getting, people, when I used to say that, people used to say, oh, but it's so volatile. The volatility of Bitcoin right now is like 25. It's basically the same as the S&P 500.
Yeah.
So it's a unique store of value. It's a couple trillion. It's proven. It's been around for a long time. And it was the first mover, has broad public acceptance. You see many institutions that hold it, even pensions hold it, even university endowments hold it. Like Bitcoin's here to stay. The thing works. We can debate many areas of crypto, and we have off air, and I'm willing to acknowledge that some things may not stand the test of time. Bitcoin's here to stay. Really great public blockchains here to stay.
Okay.
That's good stuff.
It was good to be here with you.
Yeah.
This tokenization thing, I think you mentioned the price action. I can't tell you exactly why the market does what the market does. My sense is people are excited about public securities moving on to public blockchains, and they think we're well positioned, and I do too.
Tom, come back soon.
Will
As
do.
always, our thanks.
See you guys.
Tom Farley.
Still to come right here, Cisco shares down despite what was an earnings and revenue beat. We're going to tell you what its CEO Chuck Robbins told us about AI demand. Plus, don't miss an exclusive. The CEO of Databricks, that company just released new financials just a few minutes ago and a very hefty valuation in the private markets as well. We're back in 2.
Welcome back. We are about 30 minutes here into the hour. Here are three big movers we're watching. First up, Coherent, the stock falling despite a beat across the board. Guidance was also strong. CEO Jim Anderson telling Jim Cramer last night on Mad Money that the data center and communications segment grew about 60% from last year. The move possibly reflecting investors' ever-increasing expectations. It's been a big story. Stock giving back 2.5%. Cerebras is tumbling after its second report now as a public company, projecting slower growth compared to some estimates out there. We'll get more on the quarter when the CEO, Andrew Feldman, joins us next hour. And Cisco is also a mover. It's down despite top and bottom line beats. Revenue guidance also above street estimates. CEO Chuck Robbins joining the show last hour, speaking about some of the pressure on gross margins. Listen.
Sometimes when you have gross margin pressure, it's happening to you. And sometimes you make a cognizant business model decision that there's business out there at lower gross margins that is absolutely worth going after. So think about the fact that our operating margins last quarter were at 35.9. And what the street had been looking for from us over the last couple of years is please just maintain 34. Maintain 34. We at 35.9. We told them this year it's going to be model 35 for the year. We're being prudent early. But what happens is this hyperscaler business, it ramps at such a level that our operating expenses don't grow anywhere near in a linear way. So if it's growing 100% and our OPEX in that space is growing by 1 or 2%, that is highly profitable business for us.
Does sound like, guys, despite a good quarter, reading some of the trading notes, the investor feedback was on that first quarter gross margin guide a little bit weaker, and also the product orders. I guess they were strong, but the bogeys were like for much higher numbers, especially from the hyperscalers.
Yeah, I mean, we asked them about all those things. Yeah. Obviously, we got some answers on that, including, of course, to your point, the move as well to now report revenue guidance as opposed to just orders, although he did say in callbacks they indicated maybe they would give more information around orders, but how you had $9.3 billion in orders, and now you're only forecasting $7.5 billion in revenues. Carl, caution, I think, in some ways, perhaps, is what key word is here in terms of the forecast they're giving.
I mean, to me, it's an early test case of how the street will take a guidance of decelerating revenue. If you're going from 21 to 15 to 10 in the course of the next fiscal year, if other companies say the same thing, and with earnings up 50%, it's likely they might. How does the street take that?
There's also an AI business and a core business here, right? The security business,
the enterprise,
that's doing well.
the old the telecom business, and obviously, AI, which is a new business for them. It's only been 5 or 6 years.
Coming up after this, Databricks just out with some new financials after closing a $5 billion round at a $190 billion valuation. We're going to be joined by the CEO. Tomorrow, Disney's chief Josh D'Amaro sitting down with our Julia Borston live at D23, where the company has historically at least made some major announcements about upcoming films, shows, and theme park attractions. Stay with us.
Welcome back. Time for a CNBC News update. Mackenzie Sagalos has that for us. Mackenzie.
Hey, good morning, David. Prosecutors in Los Angeles say a grand jury has indicted Nick Reiner for the stabbing deaths of his parents, Rob and Michelle, and added a special circumstance of lying in wait with a deadly weapon. Now, that makes him eligible for the death penalty. Reiner pleaded not guilty to murder charges back in February, but the grand jury indictment allows prosecutors to go to trial without presenting their case at a preliminary hearing. The top editor of Forbes was fired after he received a $6 million payment from the founder of a firm who has a business partnership with the magazine. That's according to a New York Times report, which says the payment to former Forbes chief content officer Randall Lane came from RJ Shook, whose company works with Forbes on lists of top wealth advisors. A source told the Times Lane didn't disclose the payment to Forbes because he considered it to be a gift. And a single winning ticket was sold in Illinois for last night's $1 billion jackpot. This was the 8th largest Powerball prize in history. The winner can choose a lump payment of $450 million or 30 annuity-like payments over 29 years. Back to you, Sarah.
Not bad. $1 billion jackpot. Thank you, Mackenzie. CEO of Databricks coming up with us after the break, just out with new financials after closing a $5 billion funding round. We'll ask what it all means for potential IPO. Plus, next hour, do not miss the CEO of Tapestry. Shares at the bottom of the S&P right now after results. Sales of Kate Spade falling 7% despite strength in the Coach brand, which has been a long-running story now. We'll talk about all of it with her in the next hour. Don't go anywhere.
DRAM stocks have had a bumpy ride this summer, but is the sell-off actually a warning or is it a buying opportunity? We'll talk to an expert who tells us why he's so bullish on the space despite the volatility, or maybe because of it. Tune into our Market Navigator segment today on Power Lunch. That's at 2 p.m. Eastern.
Welcome back. Databricks, the private data organization and IA company, announced new financial milestones this morning. It hit more than 80% year-over-year growth. It has a $7 billion annual run rate now, and closes as well on a $5 billion funding round that values the company at $190 billion. John Fort is with us right here at Post 9, along with the CEO of Databricks and his co-founder, Ali Ghodsi. It's a CNBC exclusive. John.
David, thanks. Ali, good to see you.
Likewise.
So, Ali, why are you playing with our emotions? You say 26 is a terrible year to IPO, then you put out numbers like this. We kind of knew about the $190 billion valuation, but Lakebase, which is your product built for AI agents, now at exceeding $100 million run rate. Tell me about what that says about agentic demand right now, and why you think it's still not okay to jump into the IPO waters with that kind of an environment.
Yeah, no, I mean, the demand is crazy. What's happening basically is everybody's using these agents, AI agents, and the whole world is laser focused on agents, AI, and sort of, that core part of it. But what they fail to look at is that drives a lot of other things that are around it, that are adjacent to it. So if you're using agents to write software, well, all the software needs a database. So that's that Lakebase database that we launched, and we only launched it last year. So in 1 year, it crossed 100 million run rate revenue gap, right? So that's like one of the things that's close to it. Another one is, enterprise people ask questions from their data. But these models don't have context. So we launched another product that's not exactly an agent, but it's actually sort of like your business agent that knows everything about your business. It's called Genie. And, that's also growing, extremely fast. And then there's this whole token maxing thing, right? How do we control our costs and so on? So that's a third product that we have. We call it AI Gateway. So, our strategy is, let's focus on all the things that are going to see a secular shift from agents and AI and focus on them rather than going to build, the core thing, which is, large language models or something of that nature.
So let's talk a little bit about cost. So you're talking about context when it comes to agents and Lakebase. Context these days is expensive because you got to store that somewhere, and memory and storage is really in short supply right now. I think you've already said your gross margins are going lower, and part of the reason for that is the expense of models. So take me through what you're doing about memory and storage allocation for yourself, for your customers, and then how this open source, open weight model debate factors into your strategy. Because if models are open for a lot of work, they got to be less expensive, right? Especially if you're adding context to them that makes them more effective.
Yeah, those are great questions. So start with the storage one. On the storage one, what we do is we're multi-cloud. We exist on all the clouds. And with Lakebase, which is this database that we built, that we announced last year, the one that crossed 100, it separates the compute and largely stores all of the data on really cheap storage, what's called the data lakes in the cloud. So that way we can compress the price down. We also compress the data when we store it. So that way we can sort of make sure that this is being stored efficiently and that we can actually do that in a way that's manageable. But more importantly, people are just using these, so going over to the open source side, people are using, the largest, smartest model they can find for everything. You want to rename a file, they'll use the smartest model and it might cost them, a few cents. That doesn't make any sense. So what we built there, and we didn't actually frankly know that we were going to see such crazy demand on this, was that on our AI gateway that we built, we gave them just a budgeting feature so that you can set budgets on your models. And then when you start approaching the budget, our AI gateway can downgrade and use, smaller models or, cheaper models. And that has absolutely exploded. The thing actually that surprised me the most was that I would say a year or two ago, our customers were saying, we don't want to use Chinese open source models. Please, that's really important. Our legal team says that. But then since token maxing has happened this year, they're all like, give us Kimi, give us GLM, give us the latest Chinese models. We got to get these costs down.
Is that because these Chinese models specifically are so good, or because there aren't enough homegrown U.S. or other country options in open source, in open weight for these companies to grab from? I mean, is this sort of the same kind of supply chain issue almost that we encountered during COVID, where it's like, okay, well, maybe for certain critical components, in this case, open weight, open source models, we shouldn't have to go overseas to source them.
Yeah, 100%. It's, if there was an American model, they would use that. And actually, now with Glimmer from Meta, and there's more works happening and there's more discussions about open source models coming in the US, because now we see that we need to tap this demand. I think the attitude a year or two ago was we just need frontier proprietary and we can just ignore Chinese models. But then what has happened is that this token maxing has freaked out the CFOs. So the CEOs were saying, do AI, I don't care what it costs. So that's what happened. But now the costs are exponentially growing, but the revenue is not exponentially growing. The productivity gains are there, but they're not exponential. They're not matching the costs. So then the CFO is stepping in and saying, hey, we're not going to be able to, we're going to miss our numbers. We're going to not be able to, exist as a company if this continues. We need to get costs down. What are our options? And so far in the last 6 months, it was open source from China. But I do think we're going to see now that gap close from American open source as well. I'm very hopeful.
So, Ali, I got to ask the Snowflake question, because that's the public company comp that you're always going to get. Right now, as a private company, your valuation is much bigger than theirs, but their profitability picture looks a lot different from yours. I think they're looking at 23% free cash flow margins, but you're still optimizing for growth. I mean, if you're concerned with growing things like Lakebase, does that become an incentive for you to stay private for longer? Because then you don't have to quarter after quarter ride the profitability chain that the likes of Snowflake do.
No, you could also look at a Palantir, and you could say that, if Databricks went public, maybe it would have a valuation that would, match that. Or there are companies that have even higher multiples, right? So it kind of depends. I think the market really wants to see AI. And we've kind of really run away with AI compared to, some of those peers that you mentioned. You can see that on the growth rates, right? So growth rates above 80% tells that story. You mentioned gross margins actually going down. Well, that's actually one of the things you see in AI. Companies that really go in and they're on the token path looks more like that. That's, by the way, why we break up our financials. We share exactly the core business where the gross margins are fantastic, and that's also growing really fast and also accelerating 6 quarters in a row. But we also share the token path, and that's just going gangbusters. And yeah, that has a different margin profile, which is the case with all AI companies. So no, I think investors across the board, private, public, crossover, are interested in companies that are on the token path and then also have a really amazing business that is sort of the foundation. Also, I would like to say, we have been free cash flow positive in the last 12 months and before that as well. So it's not like we're burning hordes of cash.
So, Ali, that sounds like an argument maybe to go public sooner rather than later. Maybe it's not such a bad time. So tell me, I mean, I know that there's the argument that some big issues, SpaceX, others, sucked the IPO oxygen out of the room in 26. There's the argument that in 27, it could be Anthropic, it could be OpenAI, who knows how long they wait. Well, why wait? Why not? I mean, with the story that you just told, why wait?
Yeah, look, the demand is insane. We just want to invest in these, the Genie product. All of our customers want it. They're amazed that it has all this context with the ontology and it can give it to, the AI. With the cost controls product, with the Lakebase product, we just want to double down on those. I don't want to go public and then have to sit there, the markets have been really wobbly. For 3 months, it's like, oh my God, everything is down and it's going to be terrible. The other day, it's like, oh no, it's amazing. And, it's fantastic. Look, there was like one great print by one software company, and then the whole market is up 10%. And then the other day, everything is down 10%. So, it's just very turbulent times. So I think during big transitions like this, it's good to be able to just focus on your business. If there is so much demand, just build for the future. We will be public. Yes, you're right. You've observed that, we're paying attention to, margin profile, cash flow, all that. That means we want to be a public company. We're not just a company that wants to stay in the private. But right now, I just think there would be too much distraction in the public market. We will go public, I promise.
It sounds like perhaps, and don't let me put words in your mouth, you never would, that the shadow of 2021 is hanging over 26, 27 a bit. I mean, that's, if I recall, when Snowflake, when maybe, let's see, Affirm, I've seen some of these companies went public, and it was really volatile, and on the comparisons, they really paid. Is that what you're trying to avoid?
Yeah, look, I would say that's definitely in the back of my head. It affects things, right? And seeing that story, how it paid out. Like in 2021, people were like, so excited and it was like nothing. And then in 2022, it's like the opposite. And just the kind of backlash and back and forth, trying to avoid that. We have the capital right now. We want to build for that future. We are going to go public. So then the question, of course, the natural question is then when? Maybe when there's a little bit more stable waters, calm waters, where there's a little bit of more stability and predictability, we will go. And I guarantee that.
So you're saying when we need the news, you're going to provide it. Looking forward to that. Ali Ghodsi,
exactly.
CEO of Databricks. Thanks for joining us exclusively on CNBC.
Wow, great stuff, John. Thank you for that. That's our John Ford. As a reminder, Databricks ranked number 3 on this year's CNBC Disruptor 50 list. If you want to see the full list, you can always go to cnbc.com/disruptor50 or just scan the QR code on the screen. Pretty candid on all that stuff.
I love that about Ali.
Yes.
Also, I promise we'll go public. You can hold him to that.
I'm sure he's promised a lot of people and care a lot more.
John, thanks. Still ahead, some outsized moves in the shipping industry to get to, including Hapag-Lloyd quantifying now the impact of the closure of the strait when we return. Welcome back. 2 of the world's top container shipping companies out with results and detailing the impact from the closure of the Strait of Hormuz. Our Pippa Stevens joins us this morning with that story. Morning, Pippa.
Good morning, Carl. Well, Maersk and Hapag-Lloyd in the green today as the shippers say that global turmoil has not impacted demand. But both companies warning the infrastructure around shipping, including at ports and on roads, can't keep pace with these disruptions. The war with Iran, now in its 6th month, has pushed cargoes bound for the Middle East through alternate ports, with more cargoes also now going by land, with Maersk CEO saying it's created significantly more unbalanced trade flows with volume levels that are challenging landside infrastructure capacity. He told CNBC that's impacting freight rates and that it's going to take time to catch up on 15 years of underinvestment in the sector. He added, we'll see, quote, more and more bottlenecks. The company raised its full-year guidance for the second time in 2 months as revenue jumped 20% year over year. Hapag-Lloyd also noting significantly higher spot rates, although the company took a $600 million hit from the Strait of Hormuz being closed, saying it's resulted in additional costs for bunker fuel, insurance, storage, service, rerouting, and inland transportation. Guys?
Meantime, Pippa, you've covered well the water levels on the Rhine in Europe. We've reportedly asked Ukraine to stop targeting ships in the Black Sea. I mean, there's so many choke points right now.
There are so many choke points. You add in Panama, Hormuz, Bab el-Mandab, and now the low water levels, as you noted, in the Rhine and the Danube. And it just speaks to the fact that shippers are scrambling to find new routes. And one thing that I think is really interesting is this week, Chinese shipping company Sealand said that for the first time, they're going to operate a regular route from China to England going north. And so going in the Arctic along the northern route that's traditionally been controlled by Russia and up until recently was pretty unsurpassable thanks to the need for Arctic icebreakers. Now, this is only a temporary route from now until October, but it does speak to the fact that shippers are looking for alternate routes as, the usual trade flow is being disrupted. And for the shipping side, this is good because the inefficiencies do raise the spot rates that they're getting. But one thing to note is that because VLCC rates are on the rise, we've now seen a record order book for new tankers. And of course, the last time we saw this was after 2008, when the tanker market then went into a recession, and it was very bleak for many years. So I think these rates are rising with these global inefficiencies, but there's a little bit of caution warranted here to make sure we don't then overcorrect on the other side.
Right, classic. Pippa, thanks. Important story, a global story. Pippa Stevens this morning. Meantime, all-time highs this morning got to 78.16, and year to date, David, that would take your S&P return to 14%. They say never short a dull market, or at least a sleepy August market.
Yeah, and we've got the NASDAQ comp up some 15.3%, so outperforming the overall S&P. The names you might expect to participate are doing so, with Apple actually showing a bit of signs of life after what's been a recent pullback, certainly since its earnings. Meta shares up, Alphabet also higher a bit, NVIDIA, AMD, Oracle also, I would note, as well higher. So a fairly broad-based rally.
Don't forget Micron at the top.
Oh yeah, I haven't actually seen that. Yeah, Micron as well.
But it's broad. It's not just tech.
No,
I mean, it's tech.
Names that you don't always see participate. You're right. I mean, Netflix shares are up 4%, for example.
That's part of the Ackman story today?
Yeah, Pershing Square. But also consumer staples are up. I mean, healthcare is up, utility. So it's a mix of sort of defensive, cyclical, and technology. I think, more evidence that price pressures are easing helps psychologically as well. The core PPI wholesale number was a little bit softer. That's good. And the overall PPI was flat, which is definitely not as good as the month before. But I think that there was some expectation it could be worse given the fact that we did see oil prices rise during the month of July.
The super core PPI has beaten consensus for 5 out of 7 months this year. That's something to keep an eye on. We'll get more tomorrow with retail sales and UMISH. Cerebras, meantime, getting crushed, but off the lows on the back of results. CEO is going to join us in a First on CNBC interview when Squawk on the Street returns. Good Thursday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Sarah Eisen, live at Post 9 of the New York Stock Exchange. Today, shares of AI chip maker Cerebras tumbling after that Q2 loss, and despite lifting their outlook for the full year. We're going to dig into results with the co-founder and CEO, Andrew Feldman.
Plus, shares of Tapestry are tumbling, among the biggest losers right now on the S&P after underwhelming quarterly results and a gloomy outlook. We'll talk about all of it with the CEO, Joanne Crevoiserat. She joins us to discuss Q4 results and the outlook. And 19 months after the LA wildfires devastated the Pacific Palisades neighborhood, a significant milestone of recovery set to take place this weekend. The owner of Pacific Palisades Village, Rick Caruso, will join us as the iconic shopping center gets set to reopen after millions in renovations.
Speaking of milestones, another 100-point milestone this morning on the S&P. 7,800 is going to be an all-time high. Got a lot of things happening. VIX is closer to 14 than 15. NASDAQ up almost a full percent. Oil's down, yields down. Pretty constructive market.
Small caps joining the party, too.
Yeah,
I mean,
IWM
they're
all-time
lagging
high.
overall, but still, not too shabby.
Yeah. For more, let's bring in Chief Market Strategist at MedLife, Drew Mattis, joins us this morning. Talk about the PPI print and some of this, I guess, wealth effect action, Drew, which we're going to get retail sales tomorrow. It's hard to imagine that this is not at least some tailwind for the consumer.
Well, that's right. It's hard to imagine consumers aren't going to keep spending because we know that consumers have kept spending. And it doesn't seem to matter what happens with payrolls. It doesn't seem to matter what happens with inflation. Consumers just keep pulling their wallets out and spending. It's not all the upper income anymore. It's kind of drifted a little lower. And, it's something to bear in mind. But, at the same point, there are some worrisome signs. The payroll reports have been declining every month. The growth number has declined every month relative to the month prior. For 4 months in a row now. So something is going on in the labor market. It's not great. But as long as the equity market holds up, the consumer is probably going to hold up.
Right. We had a long discussion this morning about bonds and these auctions this week. The 10-year auction was weak. The budget deficit for July, 5-year high. We had a discussion about how the 10-year is not really responding to some of the weaker elements of CPI or jobs. What do you think is happening there?
Well, if you want the pessimistic story, it's just there's a lot more uncertainty, and so that has to be priced into the premium that you pay for longer dated securities. If you want the upside concept, it's that people are anticipating that AI will boost productivity. Productivity gains will boost potential growth. Potential growth then results in higher potential growth results in higher yields. So you can make a good argument for yields moving higher, i.e. a positive one, or you can make a negative one. The jury's out on which way that'll break.
I mean, overall, the economic data has been good. I mean, I know that jobs were weak, but, the pair of inflation reports, wasn't that a relief?
Yeah, Warsh is looking pretty good right now. He stalled for time, and that time has served him well. And I think, maybe it's, one of the things I worry about in terms of my forecast and in terms of the outlook for growth going forward is performative exercises in force. So, the Fed hiking rates because they have to hike rates because inflation's higher without some sort of explanation of, for all the talk about how we're going to get inflation lower, and they want Warsh to explain why inflation is going to be lower if they don't do anything. None of the people who want to do anything can explain how interest rate hikes would actually lower inflation if we were to have them. So, it works both ways. And the reality of it is that we're in a situation where interest rate hikes probably wouldn't do much for inflation. So what are we talking about then? We're going to sacrifice growth for nothing. So if you're going to have higher levels of inflation, you might as well have higher levels of growth.
So are we changing the target?
We're not going to change the target. I mean, I think Warsh has been pretty clear on this. The time to change the target is not when you're above it, right? The time to change the target is actually when you're close to it or kind of hitting your target over time. Target's kind of the wrong way of thinking about it, though. And, 2% is just a number. It's really the volatility of inflation that makes a difference to firms, corporations, households. If you have a high level of inflation volatility, they can't plan. If you have stable inflation, albeit elevated, you can actually plan around that, whether you're a household or a business. And so it's the volatility of inflation that actually does all the bad things to the economy, not actually a level of inflation that's the difference between 2 or 3.
I'm not sure that gets reflected, though, in the comments, certainly out of Hammock today, and maybe even Barkin to some respect. I mean, their general framing is, we're above target, been above target for 60 plus months, and that the endurance, the duration of that pressure is what's painful for business and household.
And they just figured it out now. You know, if it's been that way for 60 months, you know, the question is, why do you have to act now? And I think that, you know, once, you know, if that could be articulated, I think maybe the market would get on board. And I know there are a lot of people out there who just want to hike for the sake of hiking. But the reality of it is, you're probably not going to accomplish a lot if you hike, and you're going to cause some damage, probably to lower income consumers who you don't want to hurt. And whether or not you do anything to the equity market is kind of an open question. And so then you would just have the upper income people spending as much as they want and more pressure on the lower income people in terms of their ability to kind of make ends meet. I'm not sure what you achieve by hiking interest rates in that environment, because you're not going to pull down inflation.
Well, there's also, I mean, the argument would be financial conditions would tighten, and that would hurt, ultimately that should hurt inflation. But also, you know, now there's the job market to worry about a little bit too, Drew, as you noted, and that might keep them on the sidelines. I do wonder how, you know, we're in a weird place where we could have, you know, more joblessness, but a strong stock market and a strong economy if it's being driven by AI and a big boost in productivity. And I wonder how much the economy can hold up in that scenario if we do continue to see the job market worsen.
Well, I mean, I think we also have to think about the longer term. You know, over the last couple of years, all the job gains, if you strip out leisure and hospitality and healthcare, there have been no job gains in the economy. They've actually been negative. So we've actually been kind of operating with a very, very thin measure of error in terms of the number of sectors contributing to the economy. And then on your last point, I would just say that if you hike interest rates, it's not clear you're going to do anything to the investment level in the economy, right? So, you know, that's pretty much interest rate, you know, they're indifferent to interest rates at this point. You know, they see the need to invest, they're going to invest, and hiking interest rates isn't going to slow that down, right? And so once again, then it just becomes you're impacting the consumer channel rather than a channel that you think might be, you know, kind of overheating or whatever the Fed is you know, has in their mind.
The way you talk about it, Drew, makes you wonder why we even have the Fed funds at all.
Well, I think it's a reason why maybe they're talking about going to fewer meetings. You know, you don't always have to react to everything as it's happening. And at the same point, though, if you've waited 60-something months, you know, deciding that you have to do it next month begs an explanation for why it's so important to do it now when it wasn't important to do it 6 months ago.
Yeah, I mean, Hammock's point is, why would you wait? If it's going to take 3 to 4 years, in her words today, to get back to target, why wouldn't you start now? But I guess that's a discussion, that's the family fight they'll have. Yeah. Drew, good stuff. Talk soon. Drew Mattis over at MetLife.
Meantime, Apple is opening a new manufacturing site in Texas today, and the stock is rallying. Mackenzie Sagalos has the details. Mackenzie.
So, Sarah, Apple opening that new advanced manufacturing center in Houston later today, with Commerce Secretary Howard Lutnick set to deliver remarks alongside Apple CEO Tim Cook. Now, this is part of the company's $600 billion domestic investment push. Apple already makes AI servers at this site, but later this year, it plans to start producing the Mac Mini at a new factory that will double the campus footprint. Now, the Mac Mini, it marks a different kind of U.S. manufacturing push, a mainstream consumer product produced at higher volumes that's also found new popularity with AI developers that are running those always-on AI agents. Now, when we hear from Cook and Lutnick, I'll be listening for how quickly production ramps and how much of the Mac Mini supply chain moves with it. Today's announcement follows years of pressure from the Trump administration to build more Apple products here in the U.S., while tariffs have pushed Apple to rethink where it sources and assembles devices. Now, some tariff payments were struck down earlier this year, resulting in refunds for Apple, money that Cook has explicitly said would go toward domestic manufacturing projects just like this one.
Latinx presence in Houston today is also notable because Commerce controls the entity list, and it's been weighing restrictions on Chinese memory maker CXMT, a supplier that Apple is reportedly testing for Macs and iPhones. And with Cook now in his final weeks as CEO, I will say manufacturing, it is just one of a few big strategy moves that Apple is trying to lock down. The Wall Street Journal reporting that Apple is speaking with publishers about multi-year licensing deals. It would essentially give its rebuilt Siri access to current news and information with a possible 9-figure budget for payment. So in Cook's final stretch here, Apple really pushing forward on a few major fronts, including where it builds its hardware and what powers its biggest AI reset yet. Guys?
Mac, thanks. Important stuff. And your point about tariff refunds is the lead in the Journal today. Turbocharging earnings, they argue. When we come back, the CEO of Cerebras is with us on earnings. Stocks plunging after revenue did fall short.
Plus, SK Hynix betting $720 billion on building out the largest network of memory factories in the world. We'll bring you an inside look at that project in South Korea when we come back.
Welcome back. Watch Cerebras Systems today. The chip maker lowered this morning after reporting mixed results for Q2. Miss on the top line, but a bottom line beat, and did raise guidance into year end. Joining us this morning in a CNBC exclusive is Cerebras Systems co-founder and CEO Andrew Feldman. Andrew, welcome back. Thanks for the time this morning.
Yeah, happy to be here. Thank you for having me back on your show.
Must be, this is your second time out as a public company. You're probably getting conditioned to the streets, I guess, craving for outsized beats and raises. How is that working its way into how you deliver results and how you communicate results?
Well, look, we guided to 194 on the top line. I think consensus was about 191, and we delivered 210. That was up about 103% year over year. That's pretty good. I think we can always do better, but that's a good start. We beat on all guided metrics, and we beat consensus on those as well. And in parts of the business, we grew at truly extraordinary rates. I mean, we really nearly quadrupled our cloud business. That's extraordinary. Other parts that were related to data center, our customers' data center build-outs, those moved a little more slowly. But we're pretty proud of the results.
Do you think there's any confusion? We had a brief discussion this morning about the gap versus core revenue in hardware specifically. Was that confusing?
I think we didn't do ourselves any favors in our communication. I think we could have done better, and I think we will do better in the future. I think we have, especially in this quarter where we went public, an enormous number of puts and takes. When you're a 10-year-old company and you go public, there's an enormous amount of stock compensation that happens. We also have a complicated business in that we pass through some of our data center expenses at low margin to our largest customer. And so what we try and do is focus on what we call core revenue, core margins, and core operating margins. And these are the metrics that allow you to compare year over year. These are the metrics that allow you to compare quarter over quarter and are less vulnerable to the things outside of our control or one-time events. And we think the outlook is extraordinary. You know, we guided to more than a tripling next year in core revenue, a tripling. We said margins would be up, gross margins would be up, and that operating margins would be up. And so I think we're pretty proud of the trajectory we're on.
Yeah, I was going to ask, because you have said before that your performance will double every year for many years. So it sounds like you more than think that right now. And I think we should also note that a lot of the semiconductor stocks did trade down this earnings season. We didn't see it with CoreWeave yesterday, but a lot of them did have big beats and still traded down, I guess, on high expectations for future guides. So is there anything sort of standing in the way of the kind of revenue growth that you're expecting on the doubling every year?
It's a fair question. I think we had a pretty good several weeks if you look at the chart. And so, I mean, it was ripping for several weeks. And I think we announced results we're really proud of, big beats across the board. So I can't give you an explanation of this behavior in the market other than to say, you know, what we can focus on here is building the fastest AI chips, delivering them to customers, and working down some of the $25.4 billion backlog we have in RPO.
You talked a lot about disaggregated inference last night. Can you just talk about what the importance there is for you?
Sure.
What it means?
It's a really good question. I think as a workload matures, there's an opportunity to specialize. And the inference workload is this enormous workload that is driving a huge amount of the compute demand. It is now maturing. And that means you can break it up and you can attack the workload with different chips, each chip optimized for the part it's best at. Our partnership with AMD and our partnership with AWS allow us, in each case, for us to focus on part of the workload that is particularly well suited for our solution. And the result is that we are able to deliver vastly more compute per watt and vastly more compute per dollar while delivering them at industry-leading speeds.
Does anyone else do? I mean, is that NVIDIA Groq? Is that who does this?
That was some of the thinking behind NVIDIA Groq, exactly.
Yeah. And does it mean? Does it mean that a customer like AWS can be much larger for you?
It does. It means that what AWS can get with their Trainium is they can get the throughput of a Trainium part with the speed of a Cerebras part. And that means you can generate more high-value tokens. Faster tokens are more valuable tokens, right? Faster AI is more valuable AI. And so you can simultaneously support more customers at extraordinary speed, increases the revenue potential of your hardware and the revenue potential of your data centers.
I think you're hosting the Supernova event next week, where you're set to preview the next gen system and the roadmap. Can you give us any sense of what to expect?
Sure. What we announced yesterday was that we would be announcing new products every year, and that the expectation for the next several years would be that the performance would double each year. We're already 15 times faster than the next fastest competitor. So you can expect us to hit 30 times faster and then 60 times faster beyond that. From there, we are also announcing that the throughput, the number of customers that can be simultaneously served on our system by the end of next year will increase 20x from where it is today.
Finally, Andrew, Cisco was the other big earnings print this morning, and we talked to Chuck Robbins about this whole discussion of structuring credit in the AI build-out and whether that's a healthy evolutionary sign of the cycle or a more worrisome attempt to prolong the bullish part of the cycle. You must have a thought or two on that.
I do. Thanks for asking. I think that there is such enormous demand. I think some of that demand is being serviced by smaller companies. And I think that's okay. I think that we need not be limited to a small number of very large clouds. I think those have a phenomenal job, and they've transformed compute. But I think some of this funding, we haven't done any yet, we haven't needed to, but some of this funding, what it does is it allows smaller companies to participate, smaller innovative companies to participate in building clouds. And I think they've stepped in, and there's a real opportunity for them, and we support them.
Yeah, that is the more bullish view, that it's democratizing a bit the space away from the giants. Yeah.
Can I just ask one more quick one? Because I think a lot of investors were curious about this. I think you talked about the potential for the installed base of GPUs, basically NVIDIA's, to basically be paired with you to create these faster, cheaper AI token factories. What sort of models of NVIDIA GPUs are you looking at for that? And how far along are you? And what kind of market are we looking at here?
What I said is that we chose a strategy of standards-based interfaces. Simple, easy to use, standards-based interfaces. And that allows us to connect quickly and easily with all GPUs and all ASICs as well. And so while we've begun with AMD and AWS's Trainium, there are certainly opportunities to connect with others, whether that's NVIDIA, who's obviously a market share leader, or Google with their TPUs, or others still unannounced. I think being standards-based, having simple, clean interfaces allows us to partner with all of these different parts to allow each part to do what they're absolutely best at. And I think there is a big installed base of GPUs, and I think we're really excited to have the chance to connect to them and deliver some value for their customers.
Andrew, appreciate the extended discussion and appreciate you coming on as well. Really helpful to the viewer. Thanks so much, Andrew Feldman.
Hey, thank you for having me. I appreciate it.
All right, still ahead on the show, speaking of semis, SK Hynix is undergoing the world's largest memory fab build-out. We'll bring you an exclusive look at this massive project.
Rick Caruso's Palisades Village reopening more than a year after the LA wildfires. He's going to join us to discuss that rebuild and real estate at large when we're back in a minute. SanDisk getting a big boost this morning, leading the NDX, just laying out its long-term growth strategy at its investor day this morning, expecting to grow revenue in the mid to high teens, saying, quote, "We believe we have a unique opportunity as we play in a large and fast-growing market with favorable tailwinds, and that we are well-positioned to capture the opportunity." It's a big story this morning.
Yeah, I mean, I'll say a unique opportunity with the stock up, what, 3,000%, over 3,200% over the last 12 months. Sticking with chips, SK Hynix is investing $720 billion for what it says will be the largest network of memory factories in the world. CNBC's Katie Tarasov got an exclusive look at that project, and she joins us now. So what was it like, Katie?
Yeah, that's right, Sarah. It was an amazing sight to see. We got the chance to actually visit 3 huge sites where SK Hynix makes memory chips. In South Korea, these are for AI. The biggest difference here compared to like other sites that I've visited, I've been to Intel, TSMC, was that they are building these fabs up instead of out. It's the first time I've actually been in an elevator in a clean room. About 70% of the country is covered in mountains, which makes this build out such an incredible undertaking, hence the huge amount of money. So SK Hynix is actually the world's leading maker of high bandwidth memory. This is the kind that's in shortest supply because it's needed for GPUs, AI accelerators, and that's why it's taking such a huge bet, $720 billion, as you said, despite the fact that memory is typically a boom and bust industry. So I also got a rare chance to sit down with the chairman of parent company SK Group to talk about this huge bet and about why it makes sense, why this company has such a massive investment coming.
It's like a war. Everybody wants that over the memory chip. Probably next year is the worst year for the memory shortage. The prices went up too fast. I'm really sorry about this. But, well, if everybody wants that all the chips, then I cannot just provide the automatically so well. But I'm trying to my best.
So that was the chairman there at SK Group, and it was amazing to talk to him. And Seoul, he rarely sits down with folks. I also got a chance to see 2 other sites. There's a clean room in Cheongju that is getting built out, huge expansion there for packaging, for NAND flash, which is a type of long-term memory that's used all across the chip industry as well. They're the second biggest company that makes that. Samsung is also building out in the country, and the government is actually having this huge push. The government of South Korea investing up to $22 billion. You know, we have the CHIPS Act here, but to put this $720 billion in context, there are $720 billion, you know, compare that to in the CHIPS Act here in the U.S. for all companies building out, the U.S. government is giving $39 billion. So SK Hynix is investing 18 times that for this one project. Now they're also building in the U.S. It's a packaging fab instead of a front-end manufacturing fab. And the U.S. government is actually pushing SK Hynix and Samsung, which is second in high bandwidth memory, to build front-end manufacturing fabs in the U.S. And we'll see what happens.
Yeah, I mean, can't come soon enough. Amazing look that you got there into just the size and scale of a project, probably like we've never seen before. Katie, thank you. And the full piece on SK Hynix, we look forward to watching. It's available right now on CNBC.com.
Still ahead this morning, the CEO of Kate Spade and Coach owner Tapestry with us on earnings as the company posts a muted outlook for the year. Stock the lowest now since early February.
Plus, Rick Caruso's Palisades Village Shopping Center reopens more than 1 year after the LA wildfires. He's going to join us to discuss the rebuild and the broader real estate sector. We're back in just a moment.
Backing off of those all-time highs from earlier this morning, let's get a news update with Mackenzie Sagalos. Hi again, Mac.
Hey, Carl. So Congo's Ebola outbreak has spread to a sixth province. Africa CDC says an infected person traveled from an affected area to a previously untouched province where the patient died. The outbreak has killed more than 2,100 people among 4,500 reported cases and could become the deadliest on record. Flock Safety is tightening privacy rules for its license plate camera network after documented police misuse. The company will cut standard data storage from 30 days to 7, require searches to be tied to cases, and flag abnormal activity. Critics say the changes still fail to require warrants or independent oversight. And Hawaii's Kilauea volcano is erupting again. Lava fountain shot hundreds of feet into the air with an ash plume rising more than 3 miles above sea level. The USGS says lava remains confined to the summit crater. This marks Kilauea's 53rd eruptive episode since December of 2024. Sarah, sending it back to you.
Okay, thank you, Mackenzie Sagalos. Still ahead, CEO of Tapestry joins us on earnings. The stock is plunging despite a beat on the top and bottom lines. Plus, do not miss a First on CNBC interview with the CEO of Disney, Josh D'Amaro, tomorrow. That's right here on Squawk on the Street at 11 a.m. Eastern. We're back in just a moment. Welcome back. Take a look at shares of Tapestry, the company behind Coach and Kate Spade, falling today despite a beat on the top and bottom lines in its fiscal Q4. Pointing to Greater China and Europe as two key areas where they're prioritizing growth. Joining us here to talk about all of it at Post 9 in a CNBC exclusive is Tapestry CEO Joanne Crevoiserat. Great to have you back. Welcome, Joanne. Thank you.
Thank you, Sarah. It's great to be here.
So are you surprised at the stock price? Because the results seemed good.
Well, let me tell you about our results. We just delivered our fourth quarter and our fiscal 26 results, and 26 was really a defining year for Tapestry. We not only exceeded all of the targets we set out for the year. Back in September, I know you and I spoke, we set out 3-year targets for our business. We achieved those targets this fiscal year, 2 years ahead of time. And how we're doing that is what matters. We're growing globally. Double-digit growth across the world in our key markets, and we're acquiring millions of new customers to our brands, which is the heart of our Amplify strategy. So our Amplify strategies are working. We're embedding these capabilities deep in our company, and the best part of our story is that the best is yet to come. We see tremendous opportunity ahead, both growing in North America, but as you mentioned, also in international markets.
Yeah, because I think that was one of the questions was is the guidance good enough to have confidence in the growth story continuing?
Yeah, and the best part, as I said, is the growth story is continuing, and we're growing off a much higher base because we exceeded so much in the last fiscal year. We have now given an outlook that shows that we are going to grow durably at our algorithm into the future. So we see the opportunity to continue to drive growth. It's compounding growth on top of the growth we just delivered well into the future by exercising all of the things that are making our brands great, right? It's that emotional connection with consumers that's driving our growth, and we see tremendous opportunity.
I always ask you about the price point, but I do wonder at a time where luxury players are struggling, if you're sort of in the sweet spot, and that's been a competitive edge right now.
Well, it's certainly part of our competitive advantages, right? We have strong, iconic brands, and the value that we deliver in the marketplace, I think, is unparalleled. And that helps power our business through good times and through bad times, because it's not just about a price point in terms of the value that we're delivering. We're understanding our target consumer, and our brands speak to a broad cross-section of consumers. We work to understand them deeply and then deliver the innovation and product excellence that they respond to and the experiences around the world that they engage with. And that is what's driving our business.
You say in good times and bad times. Which one are we in right now?
Well, for Coach and for Tapestry, it's good times. We continue to invest behind our brands and bring our brands to a new generation of consumers. And let me tell you about the Coach brand. I mean, Coach is celebrating its 85th anniversary. So this is an iconic brand that has been around for 85 years. And it is one of the hottest brands for a new generation of consumers today. It has never been more relevant. So as we look at our business, both in the last year, delivering really strong growth. So good times for the brand and bringing it to consumers in a really relevant way. But we see so much opportunity as we move forward.
Does that mean that holiday is promotional or not?
No, in fact, you know, the real special thing about the business we're building is the fundamentals are really sound. We are not relying on promotional activity to attract new consumers to our brand. We are relying on our understanding of consumers, of all of the innovation and the creativity that our teams are delivering. And we're really feeding that culture of innovation and delivering the value that they respond to. And so that is what's driving our business, and it will be what drives our business through holiday. Wait till you see the product at holiday. It's going to be emotional, right? It's that emotional connection that is driving our business.
Why can't you do that at Kate Spade? I think the loss there was a little wider than expected, and you've talked about trying to stabilize the brand for a while now. So how do you do it?
Yeah, we feel great about the opportunity we see for Kate because it is an iconic brand and it has distinctive positioning. But the work that we're doing now, as we rolled it out at our Investor Day and talked about the phasing of the work, there's a streamline process where we have to clean up the brand and make sure we're resetting it on a stronger foundation. So some of that, Carl, to your point, stepping away from promotional activity, right? And resetting the brand and building those durable handbags that we call them blockbusters that can drive our growth in a healthy way. And where we're investing, we're seeing that progress. The Duo bag, we're attracting a younger consumer at stronger AUR. So building off of a stronger base. But we know we need to sharpen our creative execution to bring the distinctiveness and the clarity to our assortment. So we've made a couple of announcements this year. We're bringing Jonathan Saunders, a new creative director. He's going to start in a couple of weeks. And, the work that we're doing that he will bring will build off of the progress we're making and accelerate.
Do you have a time frame in mind of when you could return to growth there?
Well, we expect to see progress, continued progress this fiscal year. We're going to give Jonathan a chance to start. but then definitely return to growth as we move forward. And we see tremendous potential with Kate Spade.
I cited you earlier because I was doing a little thing about how Gen Z was complaining about their outlook and how bad they feel, and yet they've been such a driver for so many consumer companies, including yours. What do you see from Gen Z right now?
We love the young consumer, and they infuse so much energy into our business, and we spend a lot of time getting to know them and what's important to them. And we know that there are some big life moments that they're putting off. We know that there's stress about, the job environment, their outlook, but we also know they live in the moment and they want to enjoy the moment. And we're working very hard to deliver value that they recognize and the creativity and innovation that they recognize. They also want to be part of the story, right? Our brand and our vision is to give more people the power to bring their own style and story into the world, recognizing that this is really, truly about self-expression. And this consumer wants to leverage our brands for true self-expression, and we're providing that opportunity.
We had P&G on the other day, and he was talking about how difficult it is from a marketing standpoint because it is so fragmented, right? You can't, the ad buys are not what they used to be. It's much more influencer influenced. Does that make sense? Is that a challenge, or it's not new necessarily?
Well, I think it's a competitive advantage for Tapestry, to be honest. They're right in that, the world is very complicated, and understanding how the young customer shops, where to intersect them, with what content, on what platform, at what point in their journey, where are they discovering new brands? And we've been investing. One of the important points of our story is that we've invested behind marketing, continuing to grow our spend. So we're up to about 12% of revenue now in marketing. A lot of that top of funnel brand building. It's not product and price and promotion driven. It really is about telling the brand story in an authentic way. And what's really important is that we've built the capability to know how to do that, to reach the Gen Z consumer and make a difference in our business.
Beyond just handbags?
Well, beyond for our brand, exactly. So while we're selling leather goods and we're leaning into our core, which is really important, the marketing investments we're making are behind brand building, so the consumers understand the real values behind our brand. They connect with our brand beyond just a product and price. They understand what Coach stands for, the courage to be real, or the uplifting luxury positioning of Kate Spade about joy and confidence. And it's that shift that has been meaningful, and it's allowed us to attract new consumers to our business. We acquired 11 million new customers to our brands in the last fiscal year.
I know that's been a big part of the story, Joanne. Thank you for coming on and talking about what you're doing and what you're seeing. We always appreciate it. Joanne Crevoiserat, the CEO of Tapestry.
Thank you.
Still ahead this morning, Rick Caruso's Palisades Village reopens more than a year after those wildfires in L.A. He'll join us next to talk about the more than $100 million rebuild in just a minute.
Welcome back to Squawk on the Street. It's been nearly 19 months since the wildfires ravaged the Pacific Palisades neighborhood in Los Angeles. Now, after more than $100 million restoration project, Caruso is set to reopen its Palisades Village shopping district with 99% of its storefronts leased. And joining us now is Rick Caruso, founder and executive chairman of Caruso, which owns the Pacific Palisades Village. Rick, it's good to have you. What a milestone. Talk about what went into building a commercial project of this scale after those devastating wildfires.
Well, good morning, Sarah. It's good to see you too. Listen, there wasn't a case study to follow on this or a guidebook, and I really give a lot of credit to my team, but also the community who inspired us to come back early. So what we did, fortunately, as you know, the property did not burn down, but we had a good amount of smoke damage in the place, and we made the decision, even against the recommendations that we didn't have to go into the spaces, take everything down to the wood studs, treat the wood studs, have environmental engineers test everything, and then we came back in and rebuilt the interiors. So the apartments, the restaurants, and the stores. So everything is brand new. The outside is all repainted, new landscaping. But we said from the beginning that we're going to reopen this thing better than it was before, and I really compliment my team for pulling that off.
What did you do differently that the villages stood and survived, and why isn't that the standard in Los Angeles?
Well, it should be, especially in fire zones. So we built this without any combustible materials. We knew when we were building it, we were in a fire area. We also knew that the city was not doing a good job, or the state for that matter, in clearing brush off the mountains right behind. And so there were no combustible materials, and then we have an action plan. And we've got a rapid response team when there's a disaster. And there's a plan that comes off the shelf. And we had our private firefighters moved in, about 40 of them. We had our own water trucks, and we had retardant. And we started stationing those people the minute we got the wind warnings that there was going to be these extreme winds. And there was a fire the week before in the Palisades that fortunately got put out. So, you know, I always say what's predictable is preventable, and our team did an incredible job.
So what about the village is opening. What about the rest of the neighborhood, the Pacific Palisades? How's the rebuild going, and what is the biggest factor slowing it up?
I think it's going okay. I mean, listen, I'd always like to have it go faster, obviously. But the good news is our private team saved the whole block on both sides of Sunset. So there is one commercial block left. Everybody is reopening with us. We did a lot of street improvements that we donated to the city. New street trees, new sidewalks. The city came in and did paving. The biggest challenge for people is insurance in getting rebuilt. And we've got to cure that problem in the state of California. It's ridiculous. Even with the FAIR plan that's operated by the state of California, they are not paying out quickly, and they're not doing it very robustly. So this is one chapter in the recovery of the Palisades, the opening of the village, but it's only one. There's a lot more to do, and we're not going to leave anybody behind. And through our nonprofit, Steadfast LA, we're going to remain shoulder to shoulder with the community and help them get back in their homes as quickly as possible.
I mean, you have been critical of the local government there in terms of readiness and preparedness. Has it been more encouraging after the fires?
Well, it's tough not to be critical. I mean, when you have a fire and you run out of water, that's a pretty bad move. The city was just not prepared. They were flat-footed, and it was wrong. And this fire, we know now, based on the after-action report, could have been prevented. So that's really a sad, sad story for the city. I think they've got better footing. There's more that they can do. I know in getting the village reopened, the mayor's office, the council office was helpful. They cut through a lot of red tape because we needed to move very quickly. And so we formed a good partnership with them. So they're getting better, but there's a lot more they could be doing, in my opinion.
I mean, you lost to Karen Bass when you ran in 22 and then decided subsequently this time not to run for mayor or governor. I'm curious why you made that decision, Rick, and how you look at the economic prospects for the city and the state.
Well, I made the decision based on what I thought was best for the family at the time. You know, politics, and I loved running for mayor, and it was one of the greatest experiences of my life, and obviously I wish I would have won, but I didn't. And I decided this time the politics have just gotten so radical to the right and radical to the left. You know, can a moderate really get things done even if I could win? I think there was a good prospect I could win, but I wasn't quite sure I could be effective. And you see this happening in a lot of major cities now, on what's happening in New York, what's happening in LA. San Francisco's on a much better trajectory with Dan Lurie up there. He's doing a great job. I think the economic future of the city, we've got some work to do. And I'm going to stay very involved and do what I can as a private citizen to help the city, work with the elected officials, work with Karen Bass, because we've got to bring businesses back in. We've got to keep the entertainment industry in the city of LA. We're losing it. We're losing a lot of jobs, and we're not building housing in the city of LA, and our rising costs are hurting young people trying to live in this city. So there's a lot of work to do, but I'm an optimist, and I believe in LA. I think it's the best city in the world, and I believe in Angelenos, and we're going to get through it. And the opening of the Village, I think, is a really great, positive sign, not just for the Palisades, but for the whole city, that there's a resilience. You can work hard, you can buckle down, and great things can happen in spite of maybe some incompetence.
Yeah, well, private investment goes a long way. Rick, thank you very
does.
much for joining us today.
Hey,
we
thanks,
appreciate it. A big day for you, and we'll have you back soon to talk about maybe more of the economic case for California. That's Rick Caruso.
Yeah. All these companies, they threaten to leave, but they often stay in cities like New York and LA.
Many billionaires have left. California.
7777 here. Let's get to the judge.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Record highs for stocks. After the latest inflation read comes in light, yields falling. We're trading the markets with the investment committee. Joining me for the hour today, Josh Brown, Stephanie Link, Jenny Harrington, Malcolm Etheridge. PPI was cooler, yields are lower, oil was down. We were 50-50 on a rate hike for September. Probably a hold seems more likely today after these most recent inflation prints. Decent mix of sector performance today. 8,100 remains in the line of sight, that according to Citi, and they lift their earnings estimates as well. Plays right to the theme we've been talking about. 8,000 seems to be the floor on the street. They keep bumping up their numbers. Why? Because earnings remain so robust. FactSet today, the S&P's highest revenue growth since the fourth quarter of 2021, the highest net profit margin since FactSet began tracking that metric all the way back to 2009. That's the story.
That is the story. You're absolutely right. Look, there are people in this business who choose to direct their energies focused on Fed gossip and what two words might be missing from the statement this week, or they will look at one data point that agrees with their priors, like a retail sales miss or something to do with ISM, which I don't even know what that stands